Hello, and welcome to Stock Market Fever. Today is Thursday, May 5th, and the stock market went deep red today as the Dow Jones dropped over 1,000 points to close just below 33,000, just one day after it closed up over 1,000 points. What's going on here? Will the market continue its wild ride, making massive moves out of mass fear and greed? Is there money to be made during these wild moves? Some analysts linked Wednesday's surge to Federal Reserve Chairman Jerome Powell's declaration that a 75 basis point increase would not be considered by policymakers at upcoming meetings. Powell's statement came after the Fed raised interest rates by a half point on Wednesday, as predicted, for the first time since President Bill Clinton's second term ended in 2000. The Fed has been raising interest rates to battle a spike in inflation that resulted from the COVID-19 shutdowns and dislocations and has been worsened by the horrific crisis in Ukraine following Russia's incursion in late February. Some industry observers attribute Thursday's sell-off to concerns that inflation will continue to plague the U.S. and global economies. But amongst the mass sell-off on Thursday, there was a couple of interesting spots of resistance and possibly even good opportunities to get a very good return with option spreads. Twitter actually closed up $1.30 to finish the day at $50.36 as Elon Musk's buyout seems more likely to happen, as Musk revealed a list of backers in a regulatory filing on Thursday saying they plan to fund more than $7 billion of the Twitter transaction. Although there is no guarantee that the buyout will happen, it looks pretty solid, and it is expected to close in July. Thus, while we offer no advice, we feel a good bet would be to buy the Twitter AUG49 calls at its closing price of $3.75 and sell the AUG55 calls at 30 cents for a net debit of $3.45. Assuming the shares are bought out at the already agreed purchase price of $54.20, your profit from exercising would be the difference between the 49 long strike price and the $54.20 buyout equals $5.20. Subtract the net purchase price of the spread of $3.45 and you have a maximum profit of $1.75, which represents a 50% ROI in just under 4 months, excluding commissions and exchange fees. So, in this example, if you were to buy a 10-call spread, your profit before fees would be $1,750 based on a $34.50 purchase in just under 4 months. That would equate to a return of just over 50% in about 4 months. If the buyout completes in July, then the return is even faster. Could you lose money in this scenario? Absolutely yes. If the buyout does not happen due to regulatory or unforeseen reasons, or if the buyout is delayed beyond even the August expiration, you could lose money. But if the buyout looks like it would be delayed by a couple of months, you could exercise the long calls and simply wait it out. Anyhow, that's what we think is a relatively low-risk investment for a relatively good reward. But what do you think? Does this spread make sense to you, or do you think it's too risky? Or do you see an even better play using Twitter call options? Please leave your thoughts and comments below, as we'd love to hear from you. And please remember to smash the like button and subscribe for future actionable stock market news and alerts right here at Stock Market Fever.